The charts are a sea of red. Your portfolio is bleeding out. The entire crypto market is in a nosedive, and as always, everyone has a theory. The mainstream media, the so called gurus on social media, they're all pointing at the usual suspects. They'll tell you it's just another exchange hack, some whale manipulation, or good old fashioned panic selling. They're telling you to just hold on, that this is just another crypto winter you have to ride out. But what if I told you they're all missing the real story? They're staring at the smoke and completely ignoring the fire that's actually causing it. The truth is, this isn't just another cyclical downturn. This isn't about Bitcoin's chart or some failed DeFi project. This is a calculated perfect storm, a combination of a fragile global economy and high stakes political games that has fundamentally changed how digital assets work. This time is different. The rules have changed. And in this video, I'm going to walk you through the data step by step to show you why. We're not going to look at squiggly lines on a chart or listen to empty sentiment. We're going to pull back the curtain on the macroeconomic machine and the geopolitical chessboard where this war is actually being fought. So, forget what you think you know. Let's uncover the real reasons for this crash, because by the end, you'll see this market in a whole new light. The story you're being told is simple and it's dangerously wrong. Yes, people who over leveraged are getting wiped out. Yes, the fear is so thick you can taste it. But those are symptoms, not the disease. The real cause is a massive shift in the global landscape. For years, crypto was its own little universe, a wild west that didn't really care about the policies of central banks or the trade disputes of superpowers. That era is over. Today, crypto is no longer an outsider. It's been pulled into the global financial system, and that means it's now exposed to all of its problems. With more big money investors in the game, the risk of a problem in the traditional world infecting the digital world is higher than ever. The crash we're seeing right now is the first major test of this new reality. It's a brutal baptism by fire, and it's being driven by three core factors that most analysts aren't connecting. First, the global economy is sputtering. It's being choked by stubborn inflation and the aggressive, sometimes contradictory moves of the world's most powerful central bank, the US Federal Reserve. Second, a new kind of Cold War over trade and technology is heating up between the US and China, and crypto has been dragged right into the middle of it. And third, the players in the market have changed. The institutional giants who finally showed up to the party are playing by a completely different set of rules, and they're making the shocks feel bigger than ever before. This isn't just a theory. We've got the data to prove it. So let's get into it. To really get what's happening to your crypto portfolio, you have to stop looking at coin charts and start looking at the one institution that has the global economy on a string, the US Federal Reserve. For the better part of a decade, crypto's biggest bull runs were fueled by one thing: cheap money. When the Fed slashed interest rates to basically zero and flooded the economy with trillions of dollars, especially after 2020, it created an ocean of cash. With savings accounts and bonds offering pathetic returns, investors had to look for yield somewhere else. This easy money world created a huge appetite for risk. Capital flooded into speculative assets, from tech stocks to, you guessed it, cryptocurrencies. In this risk on environment, crypto didn't just survive, it thrived. It was the ultimate high risk, high return gamble in a world awash with cash. But that party has come to a screeching halt, and now we're all living in the hangover. The number one enemy is inflation. For the last couple of years, central banks have been fighting a losing battle against rising prices. Their main weapon? Raising interest rates. When interest rates go up, borrowing gets more expensive. Everything slows down. But more importantly for us, those safe, boring government bonds suddenly start looking pretty attractive. Why would a massive pension fund gamble on crypto's volatility when they can get a guaranteed return from a US Treasury bill? This triggers a massive rotation of capital. Money flows out of risk on assets like crypto and into risk off assets like bonds. This isn't a theory, it's a fundamental law of modern finance. We saw this play out brutally in 2022 when the Fed's aggressive rate hikes kicked off a crypto winter. Bitcoin's price collapsed over 75% from its 2021 peak as this exact thing happened. Fast forward to today, November 2025, and things are even shakier. The market was desperately hoping that with inflation finally showing signs of cooling, the Fed would start cutting rates again and turn the money printer back on. Those hopes are what fueled the rally we saw earlier this year, which took Bitcoin to a new all-time high of around $122,000 in early October. But reality has been a bitter pill to swallow. If you read the Fed's recent meeting minutes, and trust me, I did so you don't have to, you'll see they're completely split. Some officials are worried about a slowing economy and want to cut rates, but a stronger, more hawkish group is warning that inflation is still uncomfortably persistent. The Kansas City Fed President J. Randall Schmid even said it was too early to think about easing up. As a result, the market's hope for a December rate cut has been crushed, taking all that optimism with it. This isn't just a crypto problem, it's an everything risky problem. We're seeing sell offs in speculative tech and AI stocks, and that negativity is spilling right over into crypto. So now we have a simple rule. When the cost of money goes up, the price of speculative assets goes down. This is made even worse by the strengthening US dollar. Since most crypto is priced in dollars, a stronger dollar makes it more expensive for anyone outside the US to buy, which just adds more downward pressure. What makes this a true earthquake is the total uncertainty. The US government has been dealing with shutdowns that have delayed critical economic data. This means investors and even the Fed itself are flying partially blind. That lack of clarity creates a vacuum, and fear and speculation love a vacuum. In this kind of environment, the default move for big institutional players is to sell first and ask questions later. This direct link to macroeconomics is the new reality for crypto. It's not an isolated island anymore. Its fate is now chained to the decisions made by the Federal Reserve. The dream of Bitcoin being an uncorrelated digital gold that saves you from bad central bank policy has, for now, been shattered. Instead, it's become a leveraged bet on the wider market. When the macro outlook is good, crypto flies. But when the Fed gets tough and fear takes over, crypto bleeds faster and harder than almost anything else. If the Fed's policies created the dry tinder for this crash, the escalating conflict between the United States and China was the match that lit the fire. On October 10th, 2025, the market was hit with a geopolitical shockwave. In a dramatic escalation of the trade war, Republican nominee Donald Trump announced his intention to slap a staggering 100% tariff on all Chinese imports. This wasn't just a threat, it was a declaration of economic war. The official reason was to retaliate against China's move to restrict its exports of rare earth metals, materials that are essential for everything from iPhones and EVs to F-35 fighter jets. China was making a power play, and the US response was just as aggressive. The market's reaction was immediate and brutal. Stocks tumbled, but the crypto market fell off a cliff. Within 24 hours of the announcement, hundreds of billions of dollars in value were wiped from the total crypto market cap. Bitcoin's price plummeted from around $122,000 to below $107,000 in hours. But the real carnage was in the leverage markets. Over $19 billion in leveraged long positions were liquidated, poof, gone, in one of the single largest deleveraging events in crypto history. So why did a trade fight between two countries cause such a massive collapse in crypto? There are a few layers here. First, this trade war is hugely inflationary. Tariffs are just taxes on imported goods. A 100% tariff means the cost of almost anything made in China would double overnight for Americans. This feeds directly back into the inflation problem we just talked about. A spike in inflation would force the Fed to keep interest rates higher for longer, or maybe even raise them again, which would be another gut punch to crypto. The tariff announcement was a double whammy. It signaled global instability and killed any hope of the Fed riding to the rescue. Second, the market now sees geopolitical conflict as a major risk-off event. In the past, some argued Bitcoin could be a safe haven, like gold during times of trouble. The idea was that people would flee unstable currencies for the safety of decentralized Bitcoin. While that narrative had some legs during the early days of the Russia-Ukraine conflict, it has completely fallen apart this time. Why? Because of the institutionalization of crypto. The hedge funds and asset managers who now dominate the market don't see Bitcoin as a safe haven. They see it as a high-risk tech stock. When a huge geopolitical event happens, their playbook is simple. Sell risky assets. They sell stocks, they sell tech, and they sell crypto all at once. This has made Bitcoin's price move in lockstep with the stock market, especially the Nasdaq, during a crisis. Instead of being a hedge against chaos, crypto has become a casualty of it. The third impact is on the very hardware that makes crypto run. China's restrictions on rare earths and potential US tariffs on Chinese goods create a huge supply chain nightmare for crypto miners. The advanced chips and specialized ASIC miners needed to secure the Bitcoin network are heavily dependent on Chinese manufacturing. These trade restrictions mean the cost of mining hardware could skyrocket, squeezing miners' profits and potentially forcing some to shut down. It's a direct attack on the economic foundation of the network. The market's reaction proved the point. The small rebound we saw later in the month was tied directly to news of a tentative trade framework agreement. It shows just how closely crypto's price is now linked to the whims of international politics. This trade war has turned crypto into a piece on the global chessboard, and it just learned that it can be sacrificed in a larger game. The first two forces, the Fed and the trade war, set the stage. But the third force is what turned a bad situation into a catastrophe. This is the fundamental change in the market's DNA, all thanks to the flood of institutional money that has poured into crypto. For most of its life, crypto was a retail game. It was driven by individuals, enthusiasts, and hobbyist speculators. This made the market volatile, but crashes were, in a weird way, more contained. The 2018 crash, for instance, was mostly just retail investors giving up. Today's market is a completely different animal. The launch of spot Bitcoin ETFs in early 2024 was seen as the final seal of approval, legitimizing crypto for the big players. And it was. It opened a fire hose of cash from hedge funds, pension funds, and corporations. But that institutional adoption came with a dangerous side effect. It created a powerful feedback loop that makes both the ups and the downs way more extreme. Here's how it works. Unlike a retail investor who might hodl through a downturn out of belief, institutional investors play by different rules. They have risk mandates and algorithms. When the macro and geopolitical alarms start blaring, their response is immediate and systematic. They de-risk. This isn't emotional panic selling, it's calculated, automated, and massive. As these institutions started selling in response to the tariff news and the Fed's stance, the price began to drop. That initial drop then set off a chain reaction that is unique to this new market. The biggest factor is ETF outflows. The very things that brought so much money in have now become a fire hose for money going out. In November 2025, we saw a record $3.5 billion flow out of US Bitcoin ETFs. That's institutional money running for the exits. When a fund redeems its ETF shares, the ETF trust has to sell the actual Bitcoin on the open market to pay them back. This creates relentless downward pressure on the price. This selling gets amplified on offshore exchanges where professional traders use insane amounts of leverage. When the price started to fall, all those leveraged long positions went underwater, triggering margin calls and forced liquidations. We saw days with over $800 million in liquidations, and on October 10th, that staggering $19 billion. This is that vicious cycle in action. Institutional selling pushes prices down, which triggers liquidations, which forces prices down even further, which then causes more ETF outflows and more selling. Analysts at Deutsche Bank even noted that this crash is different because it's happening with huge institutional participation, unlike past cycles. This also explains why a recovery has been so difficult. Those massive liquidations have hollowed out the order books on exchanges. There just isn't enough buy-side pressure to absorb all the selling. In the past, a buy the dip mentality from retail could help create a price floor. But today, retail buying is a drop in the bucket compared to the scale of institutional selling. And that whole idea that institutions would be the strong hands, well, that didn't exactly pan out. While some long term focused funds have reportedly been buying, many more are selling. Even long term holders who usually buy during downturns have been spotted selling, maybe because they fear the reliable old 4 year cycle is broken in this new macro sensitive world. The game has changed, and the institutions that were meant to be saviors have, through their normal risk management, become amplifiers of the collapse. Look, if you appreciate this kind of no nonsense analysis that goes beyond the headlines, make sure you subscribe to the channel and hit that notification bell. The market is changing faster than ever, and our job here is to help you understand the powerful forces that are really in control. And let me know your thoughts in the comments. Do you agree that these macro and geopolitical forces are the real story, or do you think something else is at play? I read all the comments, so let's get a real conversation started. So, where do we go from here? We've broken down the three forces that created this perfect storm: a hawkish Fed, a US China trade war, and a new market structure dominated by institutions. Understanding this isn't just for fun, it's critical for figuring out what to do next. The brutal truth is that as long as these headwinds are blowing, a real, sustainable recovery in crypto is going to be tough. The era of crypto just ignoring traditional markets and going on its own wild ride seems to be over, at least for now. Crypto's fate is tied to the broader economy. This means the most important things for a crypto investor to watch are no longer just crypto specific metrics. The key data points are now inflation reports, Fed meeting minutes, and geopolitical news. A surprise rate cut from the Fed could spark a powerful rally. A de escalation in the US China conflict could bring back confidence. On the flip side, stubborn inflation or another geopolitical flare up could send the market to even lower lows. For the average investor, this all demands a major shift in mindset. The up only attitude from past bull markets is a recipe for getting wrecked. Managing your risk is no longer optional, it's everything. The extreme leverage that made people rich on the way up has been exposed as a double edged sword that can wipe you out in hours. This doesn't mean crypto is dead. Not at all. The underlying technology and the long term vision are still there. You could even argue that this crash is a necessary, if painful, cleansing. It's washing out the unsustainable hype and forcing the market to grow up. And if there's a silver lining, it's that a systemic shock like this can disrupt the criminal elements that rely on crypto, which is a good thing for the long term health of the space. The key takeaway is that the game has changed. Crypto is now a macro asset. Investing in it requires not just faith in the tech, but also an understanding of global economics and politics. The road ahead will likely be bumpy. A recovery will probably require a longer, deeper period of accumulation before the market finds its footing again. So, next time you see headlines screaming about a whale sell off, remember the bigger picture. This crash wasn't started by a single whale, it was started by the Federal Reserve. It wasn't caused by one failed project, it was kicked off by a trade war between the world's two biggest economies. And the damage wasn't amplified by retail panic, but by the cold, hard algorithms of the very institutions that were supposed to stabilize the market. We are at a turning point. Bringing crypto into the traditional financial system was a double edged sword. It brought legitimacy and unimaginable prices, but it also chained crypto to a global machine that is currently misfiring. The simple stories of the past just don't work anymore. To survive and thrive in this new era, you have to think bigger. You have to look past the charts and understand the powerful currents that are truly moving the market. This crash is a painful lesson, but it's a vital one. The world has changed and crypto has changed with it. The only question now is, will you change your strategy